Hello and welcome back to the Note. I'm going to try to go through the remarkable switch around we've had in the bond market over the last few weeks. If you want more information on this, take a look at this week's long view. Now, the question is, have we reached a tipping point? If you look at the very long-term trend, and this is a truly very long-term trend, you can see that bond yields, in this case Treasury 10-year yields, have been going steadily, inexorably down for more than 3 decades now, basically since Paul Volcker brought US inflation under control in the early 1980s. Most traders trading today have no recollection of an environment when bond yields weren't steadily falling and might well get very panicked if this trend is finally definitively broken. At some point, logically, there has to be a tipping point. Now, take a look at what's happened in the Bund market recently. If you look at it in the short term, this is 5-year Bunds that actually went negative for a while, an extraordinary situation. Boy, does that look like a tipping point, a really dramatic market reverse. But now if we look at that same market in rather longer term, it doesn't look so dramatic at all. It's more consistent with simply being some kind of a correction from an extreme position. Now, if you want more support for the notion that perhaps it's just a correction from something extreme, take a look at the inflation situation. What we're looking at here is 10-year Bund break-evens. This is the implied level of inflation expected over the next 10 years in Germany compared to 10-year Bund yields. And what it looks like here is that we had a true deflation scare for a while. That dragged Bund yields down, logically enough. The lower inflation is, the lower yields can go on normal Bunds. Then you see the deflation scare recover for a while, and after it becomes clear that inflation break-evens have reached and recovered from their low, you see Bund yields recover. There's a very clear explanation for this. It has everything to do with the European Central Bank. People were concerned that the ECB was going to allow the situation to lapse into deflation. That's why they made the bet they did. Then the ECB announced QE. That almost automatically jolted the market out of the most extreme fears of deflation, but it also, at the margin, because they were buying bonds, helped push Bund yields down at first. Once it became clear that those inflation expectations had shifted somewhat higher, that gets fed into the overall picture that with slightly higher inflation for the future, bonds are worth less, and so you see yields snap back as well. Now, do we have any reason to fear that this is going to be more than a correction, that any move is going to have to be particularly violent? Well, many people point to problems of liquidity. This is the average volume, daily trading volume in treasuries. And since the crisis, there has been a lot of new regulation trying to lock the stable door to diminish the actions of the big banks, and which ultimately means that there are fewer people making markets in bonds. There's less liquidity in bonds. That therefore raises the fear that any move could be particularly violent because of a lack of liquidity. Certainly you can see that liquidity has declined. You can also see, however, that it's declined from artificially high levels because the market was allowed to get out of hand ahead of the crisis. This is a reason for some concern, not necessarily a reason for downright alarm. The greater reason for alarm about the future of bond yields is that it's very easy for central banks to make a mistake, and when they do, that can lead to trouble. I'm going to give you 2 historical examples here for why people are concerned. First of all, both come from Alan Greenspan. First of all, let's take a look in 1994. The Fed decided to take the market very much by surprise, raised rates sharply, aggressively, and the result was that bond yields went up for a while and the stock market was stopped in its tracks. It led to the Orange County crisis. It arguably led to the Mexico crisis and the ongoing emerging markets crises thereafter. The effect on the US was extremely positive indeed. After the medicine had been administered, you saw a remarkable bull market in equities for the end of that decade. Now let's take a look at how Greenspan dealt with raising rates after 2004, after they'd been cut very low following the dot-com bubble. They took an extremely different approach there, made sure that the market knew exactly what was coming, didn't want to allow for any sharp moves in the bond market, any dislocations. Every meeting they would raise by a quarter of a percentage point. Nobody was particularly alarmed by it. You can see what's happened. The stock market rallied more or less throughout until it got to bubble-like proportions in the credit crisis. Meanwhile, 10-year bond yields, there were other factors behind this, but 10-year bond yields actually managed to fall, suggesting that if you go too far towards keeping the bond market happy, you can end up storing even more problems for yourself. Ultimately, what we have at the moment is clearly a correction. It is not clearly yet a tipping point. A tipping point probably must come at some point, and it could be dangerous. It may not necessarily be so bad to jolt the bond market. Going too far to appease the bond market could itself be dangerous.